Hey guys, and welcome back to the ASX Investor channel, and welcome to another interview. Today we're diving into the buy now pay later space and talking about Zipco. Zip was a pandemic darling. However, as we know, the start to 2022 has been difficult for companies around the world as well as financial markets. There's been a range of global macroeconomic uncertainties as well as headwinds to navigate, and these have affected the fintech sector. Zipco has not been immune. Today we're going to dive into the Zipco story and talk about the roadmap up ahead as they look to navigate these global macroeconomic uncertainties on their pathway towards profitability.
Welcome to the channel and enjoy.
We're very grateful to be joined by Zipco's co-founder and Global Chief Operating Officer, Peter Gray. Peter, welcome to the channel.
G'day, thanks for having me.
Before we discuss all the news flow and everything that's up ahead, makes sense for us to start at the start and talk about the Zipco overview. We know it's been a transformative past period. There's this focus on the pathway towards profitability, refining that focus towards the core markets as well, and navigating a lot of these macro headwinds that are playing out. Can you give us an update about where you're currently positioned and how you're viewing the current situation internally at Zip?
Yeah, sure. So it's a timely reminder on our 9th birthday, which we celebrated last week. Nine years young. About why we founded the business and the opportunity that remains on those underlying principles with regards to the opportunity. So essentially, founding the business 9 years ago, we really did see an opportunity to disrupt this world of consumer and point of sale finance that had largely been dominated by the likes of GE and what subsequently become Latitude, and providing interest-free solutions as a tool for merchants to offer it at point of sale. And I think the opportunity has significantly broadened from that overarching opportunity initially, and now we really do see ourselves utilising technology and becoming a true credit card disruptor. So we did found the business with some principles in terms of our credit and decisioning platform, which will stand us in good stead as the external environment does change and is impacted by rising inflation and cost of living pressures. So the ability to manage credit in that environment becomes critical to the success of the business model. But I think we really do see our model as to some degree recession proof, in that we do provide significant benefits to consumers in times of external challenge where we become more meaningful. 54% of Australian consumers use buy now pay later to help them budget and manage their day-to-day living expenditure. Similarly, in terms of the merchant environment, merchants are looking for partners, tools, marketing channels to maintain top-line sales when there is downward pressure on top-line sales as they stare into some headwinds that they haven't been exposed to for the previous couple of years. So the actual opportunity for the business remains very, very strong in terms of being able to deliver sustainable growth. The Australian business has been profitable for almost 2.5 years and will deliver its strongest cash EBITDA result by some margin for this financial year, and we can see that accelerating into FY23. The US business remains early stages in terms of its growth journey, and the opportunity there is significant, and that's further validated by the changing competitive dynamic over there in the US as well. But I think lastly, to your point there, we have been obviously caught up in some deteriorating movements with regard to the share price and the external environment. And as you called out, we have really adjusted our lens and are really focused on accelerating that path to profitability.
Appreciate hearing that. Congratulations on the 9 birthdays as well. It's what a journey so far. I guess talking about the focus, as you mentioned, consumer-focused BNPL, we've got this macroeconomic environment at the moment. There's rising interest rates and the potential growth slowdown that's becoming more prominent in the discussions. You've obviously got a lot of data and some internal forecasts. What's your outlook, the house view at Zip, about where things are potentially heading on that front?
Yeah, so we're very well placed to continue to deliver on sustainable growth in Australia. We see it's still very early days with regard to the overall penetration of sales for BNPL as an industry more broadly. We see 5.9 million active account holders using BNPL in the last 12 months. Of that subset, Zip has more than 2 million consumers having transacted in the last 12 months. So we're sort of very well placed in terms of the market dynamic. But I think what we see is with our product differentiation and our account-based construct, we really do support consumers in a much broader range of spend. So we do have additional sort of exposure, if you like, outside of the broader discretionary spend categories where buy now, pay later has been strong. Our account-based concept really does allow us to support general cost of living groceries, fuel, some of these other items that, budgeting and, the benefits we provide with our forced repayment structure really do support consumers in a time of external challenge. Having said that, the underlying piece of the business puzzle is obviously managing your credit. And we're certainly well placed in terms of adjusting our risk appetite. We have an entirely digital platform. There are inbuilt protections in terms of the way the product is constructed to deliver better outcomes for consumers, but also for Zip in terms of the bottom line. So we're sort of pretty bullish that we can continue to deliver very, very strong sustainable growth in Australia, even in spite of rising interest rates. As I touched on, the cash profit number for the Australian business will be a significant improvement on FY21 in the upcoming results, and we have forecast to do significantly better again in FY23. So we remain pretty bullish about the opportunity.
For sure. And we've heard about the bad debts discussion a lot. It was interesting to hear you think it's a recession-proof type business model. You put out an interesting piece previously. 25 basis point rise only has an incremental 2 basis point cost of capital increase. So probably the focus is more on that propensity to pay. Can you give and really flesh out that discussion more about how you think the credit ratings are going to fare moving forward, particularly if there is more risk on the economy?
Yeah, so it's slightly different in both the markets that we operate. So just backtracking. So we have clearly messaged to market. We are narrowing our focus, our global cost footprint, and the focus of our investment to essentially the two core markets that we exist in. So the US market, I think, was relevant for the reference with the basis point increase there. So it's a very capital efficient business. So rising interest rates have less of an impact in the US on the cost of goods sold side of the equation for Zip. I think what we've seen is in a change in their external environment, we have seen a slight deterioration in credit performance from lower FICO score bands. So we're able to immediately make adjustments with regard to our risk tolerance. And I think that's one of the benefits of the business model in the US is that the capital recycles every 6 weeks. So changes you make to your risk appetite do flow through to the bottom line results very quickly. And where we're confident that we'll be able to maintain sustainable growth in that jurisdiction in spite of tapering our risk appetite is with the implementation or the integration of new business partners or merchants. So very early stages in the opportunity. An example would be Best Buy, who we've recently integrated with in the last 6 weeks. They do $15 billion worth of transaction volume online only. So for us to get a small share of that, top of funnel exposure does deliver, growth at the bottom line, even if you're tapering your risk appetite or your approval percentages in lay terms. In Australia, the performance of the receivables remains pretty strong. Losses are slightly outside our targeted range. That has not resulted in any deterioration in the credit rating. So the senior notes in our warehouse facilities are with the AAA rating, and that will hold us in good stead for the refinance of some legacy receivables in our master trust program, where we will receive a better weighted average cost of capital for those refinances to offset to some degree the increased rise in base rate.
Yeah, perfect. Appreciate that overview. I think another thing that people are always interested in is competition. It's really that double-edged sword. We know PayPal was the first that came through, then Apple, a lot of the banks. On one side, it's validation for the product and the sector. On the other, can put share as well as margins under pressure. How are you viewing that, and how are you looking to navigate it as well with the increasingly competitive landscape?
Yeah, so it's a great question. Obviously there is some noise about the sustainability of buy now, pay later and the unit economics and how the model stacks up. And yet here we have the Commonwealth Bank and Apple piling in to a business model that effectively, some call into question. So, look, I think it's certainly validation in the first instance of the business model. And we know the unit economics stack up. As a continually reference, the Australian business is profitable at scale, and as we further make adjustments to our operating cost base, will deliver much stronger cash outcomes for the Australian business. So the unit economics of the business model are sustainable. And I think with regards to the competitive landscape in Australia, obviously we see Commonwealth Bank now on their third iteration of buy now, pay later, really failing to get any traction at all. With ourselves and Afterpay as a number 1 and 2, some of the challenges in the Australian ecosystem are missing some of the components required to build a successful BNPL business. And the secret is that you're providing benefit to both merchant and consumer. And in some of the operating models of the challenges, there's no merchant benefit being provided, and there's no effective relationship with the merchant to refer traffic or increase conversions as part of the offering. So they are lacking, and to some degree, that's where they've struggled. In the US, it's a little bit different. It's very early stages in terms of the market maturity for BNPL. There is no product differentiation at all. All participants in market are effectively offering a pay in four, and Apple coming to the party will be offering the same. So as maturity plays out and competition plays out, you will see differentiation on the consumer-facing product. And that's an area that we have been very successful in Australia with our account-based model. Allows us to charge subscription fees to supplement merchant revenue with revenue from the consumer side. It does open up different industry verticals that the product can be used in rather than just discretionary. Also, the likes of Apple Pay are very low penetration levels of in-store. So we see in-store as a huge addressable opportunity for the Zip business. In the US, we've recently deployed physical cards, which does allow us to capture a very broad penetration of in-store, given the lack of tap and go sort of technology being utilized in the US. That's a great way to supercharge volume without the need to integrate into large numbers of retailers.
Yeah, perfect. And just drilling down onto that product differentiation as well. We all know that in the fintech space, the super app is everything that everyone's trying to work towards. We've heard about crypto discussed as well. We've heard about share trading a little bit discussed. Can you talk about potential product pipeline up ahead and any timelines that you are able to share at this stage?
Yeah, I think to some degree, we'll probably maintain a simplified product roadmap in the shorter term. We are very conscious of simplicity in terms of accelerating this path to profitability. So in a market like the US, as I touched on, it's very early stages in terms of the market opportunities. So we need to be very heavily focused on merchant relationships and customer acquisition, as opposed to some of the additional features that we've talked about before. We're very sort of conscious that they're nice to haves, but in this changed environment of accelerating the path to profitability, we have such a strong runway. We probably will see some product differentiation with regards to longer duration lending solutions in the US. So that does open up significant addressable transaction volume and revenue opportunity from high ticket sizes. And I think, as I touched on, the account-based concept certainly has legs in the medium term as product differentiation, allowing different usage as opposed to some non-core BNPL products in the wallet. Similarly, in Australia, we have some opportunities to unlock a different range of categories that might include marketplaces if we heavily focus on our core products. We have some new initiatives coming out for our Zip Money installments product, which effectively could provide interest-free loans at any checkout in Australia, which would obviously open up a significant pipeline for both volume, customer acquisition, and revenue. We do know that in terms of our lifetime value for customers who have both Zip Pay and Zip Money are delivering significantly higher revenues on the lifetime value side. So focusing a little bit on the cross-sell in the short term, and the core product set will remain the key area of focus for the next 12 months.
Fantastic. Thanks for that overview. I think we've talked about that macroeconomic environment, but something more sector specific as well that's often discussed is the regulation piece. There's always discussions playing out. I'd love just to hear your take on it and how you think things may evolve moving forward.
Yeah, it's a very topical area at the moment, and obviously with the change of government in the Australian jurisdiction, it's likely that the Labor government will agitate for further regulation in the space. I think Zip has been a supporter of fit for purpose, simple regulation that protects consumers, but also drives innovation and competition for some time. We put forward a policy recommendation as part of our appearance at the Senate process almost 5 years ago now, agitating for that. So we are supportive of the minister's initial moves to regulate the industry body code. We sort of see that as an appropriate first step to regulate the sector. So he has indicated that will be his first step, effectively legislating the current voluntary code. So that would mean minimal changes for most of the participants in market. Arguably, further regulation would be a competitive advantage for Zip. We have a regulated product currently in market with our Zip Money product. We have an Australian credit license. We are compliant with responsible lending obligations. We do undertake credit ID and affordability assessments on all our customers at inception or sign up already. So we're really well placed in terms of that dynamic, and it'll be interesting to see how that plays out and at what sort of tempo. But we're very well placed again. It's kind of interesting because the agitators suggest immediately that regulation delivers better outcomes for consumers. I think the Royal Commission demonstrates that that's not necessarily the case. Having said that, fit for purpose regulation would be a good thing for all participants. The US is a little bit behind Australia in terms of that process, but they are sort of following similar steps with engagement with the industry to try and understand the business model, trying to understand the types of consumers that do utilize the service, and also what levels of harm they may have from utilization of the service. So there are different legislative frameworks in the US where they have a state-based system as well. So there's a little bit to play out. But having said that, regulation will just provide levels of confidence that consumers need to continue to utilize the service. It doesn't necessarily in any way reduce the opportunity.
Yeah, and just sticking on that US piece as well, we've talked about the pathway to profitability. We all know about the Sezzle transaction that's gone on. It was at a different time in terms of share prices. Can you talk about the strategic rationale behind that and really how that's going to help you continue on this pathway towards profitability?
Yeah, so the rationale behind the transaction really was in line with our adjusted strategic initiatives to fast track or accelerate profitability with a focus on our two core markets, Australia and the US. So the Sezzle acquisition really is in line with increasing scale and accelerating profitability, particularly in the US. And the acquisition certainly ticks those boxes. We're able to immediately achieve an increased level of scale. We're able to take advantage of operating leverage and reduce cost as a blended business. So it increases revenue, holds revenue margins, and delivers a lower cost base. So it really does, fall into line. The revenue and cost synergies were assessed at the time the transaction was announced, and they remain a key area of focus to ensure that we can deliver appropriate levels of synergy and benefit to warrant the transaction.
And so on that pathway to profitability, I think you've got FY24 in terms of that cash flow break even. Can you just talk about that pathway towards there and really those key catalysts that you think investors should continue to watch for as you move on that journey?
Yeah, so we have indicated to market that cash flow break even on a monthly basis for the group will be achieved in early FY24. We really are working to see how far forward we can bring that in response to a change in the external environment. As at the last reporting date, we had north of $300 million in terms of capital to run the business, which is sufficient to get us through to that cash flow break even point. In terms of what the market should be looking for, it really is continued execution of our adjusted strategy. So how we bring the losses back into the targeted range. You'll see some further announcements at that, at the quarterly and at the full year results, which demonstrate we're well on the pathway to that. How we're tracking towards the medium-term goal for net transaction margin. So once we are delivering volumes and delivering on the net transaction margins, we become very easy to model, and investors will be able to see how far away that profitability is, but also the steps that we've taken to reduce our costs. So understanding we had a reasonably extensive global footprint, some of the steps that we have taken or are undertaking to reduce that burn. On a global basis, so that we are able to obviously narrow our focus and drive the US and Australian businesses to that profitability target.
For sure. Those changes the market will continue to look for. At this stage, at the moment, the market hasn't caught up. As we know, the growth year end of the market has sold off. We're in the correction. Zip's down 90% from its peaks. Just wanted to hear your reflections in terms of the share price itself and how you're viewing it internally.
Yeah, so there's obviously there has been a deterioration in the share price, as there has been for the whole sector and tech and growth stocks more generally. We are aware of it, and we have adjusted the strategy. So we really need to execute on the strategy now, and we're of the view that when investors do understand that profitability is almost within reach, and we are hitting the metrics and the numbers with regards to the unit economics that we are forecasting, that the share price will adjust. And, investors just actually need to see us executing on that, not just us talking about it. So obviously the external environment has changed very rapidly, as has the strategy. So, we just need to deliver on the strategy.
The pathway has been set. It's clear that the objectives are now set. Did you have any final reflections that you wanted to share with the longer term shareholders who have followed the journey, or those prospective shareholders who might be looking at ASX ZIP now?
Yeah, look, absolutely. Contrary to some of the views, BNPL is not dead. It's greatly exaggerated in terms of, the impact to the business model that the external environment is delivering. Clearly, there's a short-term depreciation in share price, but that hasn't taken away from the fundamental opportunity that Zip has. There's data being released this week about the penetration of BNPL more broadly in Australia. Very early stages in terms of the opportunity. The Australian business remains and has been cash flow break even or better for some time. So the unit economics stack up. There's a huge addressable opportunity to maintain sustainable growth and deliver accelerated profits, just off some simplification of the business model. The US market is very early stages. We continue to deliver higher gross transaction margins than our competitive peers because of our differentiated revenue model. So we're very well placed for both competition and sustained growth. We are calling out that the external environment has led to a refreshed focus on credit losses, and once those are back into our target range, the business model remains resilient in times of external challenge. So, huge opportunity for us to continue to build the business, and share price aside, we fundamentally changed the way that consumers are interacting with financial services. So 54% of our customers no longer have a credit card or traditional forms of credit. So we really are, disintermediating the banks, who clearly have a vested interest in some of the negative noise in the sector. But the fundamental shift in the way consumers pay is not going to disappear. So, we manage upswings and downswings in the share price. We've really refreshed the strategy to capitalize on the opportunity and accelerate that path to profitability, but there's still a massive opportunity for the Zip business.
That is the Zipco story. It's ASX ZIP. It's been a difficult start to 2022, but it's really exciting to hear about the new strategy and everything that's up ahead. It's Peter Gray, the co-founder and global chief operating officer. It's an absolute pleasure to have you join us. Big thank you for joining us on the channel, mate.
My pleasure. Thank you.